second quarter earnings season continues to ramp up, guys, with this past week seeing some huge giants reporting, including Google, Microsoft, and Meta. So in today's video, we're going to do a quick rundown of each of their earnings reports, including some other very popular stocks too, and I'm going to share my opinion on each one. I'll let you know how the markets reacted to them, and I'll even let you know if I consider any of these stocks to be a buy now following their earnings report. So it's going to be a ton of fun. I hope you guys enjoy the video, but sit back and relax. I'm going to run through a few different stocks for you. Let's just go ahead and jump straight into it. All right, now as always, there are just way too many stocks reporting each week for me to cover every single one of them. So I usually just pick some of the most popular or interesting stocks that kind of stand out to me. And this week we'll be covering 8 stocks in total and going in chronological order based on when they reported. So we'll do a quick rapid fire of Google, Microsoft, Verizon, and General Motors, who all reported on Tuesday. Then we'll cover Meta, who reported on Wednesday, and then we'll finish off with Ford, Intel, and McDonald's, who all reported on Thursday. It's going to be fun. Let's go ahead and run through these. Okay, so starting with Tuesday first, we had Google reporting, who really just destroyed earnings, sending the stock rising by over 10% this week, leaving it up over 50% for the year as it quickly approaches their old record highs. Needless to say, I am really glad that I bought so heavily when it was falling. I know I made a ton of videos on that, and it's just kind of funny how some perma bears always think that stocks will never stop falling when they're in decline, but in reality, the good ones always tend to recover. So you really need to make sure that you're actually buying these high quality stocks when they fall. But going back to those earnings for Google, they not only beat analyst estimates on both the top and bottom line, but despite the weak macro economy, they also managed to grow not only their sales by over 7%, but more importantly, virtually every profit metric grew by a double-digit rate as well. Guys, that's pretty crazy for a company that already does tens of billions of dollars every single year and completely dominates most parts of the internet. You just wouldn't really expect a company this large to keep growing by this much, and that was thanks in large part to their cloud business, which saw massive revenue growth of close to 30% in the quarter, while also posting its second straight quarter of profitability versus a loss the year prior. And this is a very big deal for what is already the third largest cloud platform in the world, only behind Amazon and Microsoft. Being able to continue growing like this is a great sign. And look, I'm not particularly looking to buy much more of this stock now, as I already built out a large position when it was falling, but for anyone not yet in the stock, I mean, it still somehow trades a little cheaper than the sector on a PEG ratio basis, so I wouldn't really even blame you if you wanted to get your feet wet with this one, pick up a few shares, and then maybe just add a little more if it dips or the overall market falls in the future. But moving on though, I not only have a larger position in Microsoft, but it's actually my number one largest holding in my entire portfolio, and they too reported some pretty strong numbers, very similar to Google here, not only beating on both the top and bottom line, but also managing to grow sales by 8% with profits absolutely soaring by around 20%. And this too is a huge deal, guys, because Microsoft is already one of the most profitable companies in the entire world, doing almost $200 billion in sales just last year alone, with over $70 billion of that going straight to the bottom line. Just absolutely staggering amounts of money that we're talking about here. And yet this will probably shock you, but the stock actually fell by over 5% in the 2 days following the report, leaving it slightly negative for the week. And this was mostly because of two reasons. One was lower guidance because of weak Windows sales, and the other was slower than expected growth for artificial intelligence. On the Windows side of things, the global PC market just continues to be in huge decline, with sales overall for the PC market falling another 12% this quarter, and that's after 2 consecutive quarters of over 30% crashes as well. So it's just been a horrendous environment coming off of the pandemic and lockdowns, where PCs are just not needed as much now as they were before, and so obviously that's going to hurt Windows sales for at least a little while, as it's the number one operating system in the world. However, the market does look like it's recovering slowly. It's a little hard to see on this chart here, but it does look like it's bouncing back. So I wouldn't really worry too much about this over the long term. I still expect Windows to be a powerhouse well into the future. And on the AI front, we know that Microsoft has been investing very heavily into AI through Azure, as well as integrating ChatGPT into other parts of their business and several other things too that they do. But to the surprise of analysts, Microsoft's finance chief actually noted that they won't see many of these benefits when it comes to financial growth from AI until next year, rather than what was previously expected to be this year. And so the sell-off is really just Wall Street being impatient, in my opinion. I mean, the fact that Microsoft is still growing by these huge rates, even when their business isn't operating at its full potential, is actually very impressive to me. I would say that that makes the stock more of a buy than a sell. The only issue though is that it's already up over 40% this year and is trading near an all-time high. So I can understand some of the selling and the profit taking here. And I myself have no plans of adding any more shares at a market cap of almost $2.5 trillion with a PEG ratio above 2.4. That's a bit too rich for me, guys. And I'm actually just holding on to my position for now so that I can let some of my other stocks grow larger so that Microsoft becomes a smaller portion of my overall portfolio. So that's why I'm just kind of holding. Then to finish up Tuesday, though, we also had Verizon and General Motors report. Both stocks were mostly flat this week, with Verizon only being slightly positive, which leaves it still down by around half its value from the top and trading at over a decade low. It's definitely high risk, but it's a stock that I've been picking up lately because the dividend is just so damn high right now at almost an 8% yield. I've never seen it that high. Now, of course, we also saw this happen with AT&T before they decided to cut their dividend. So you have to be very careful with these type of stocks that are crashing by such large amounts because in many cases, the falling is justified. And case in point with Verizon, they actually reported a pretty horrible quarter, beating on EPS, but then missing on sales while also declining by over 3% on revenue and over 10% on net income. So that's pretty bad. And a big reason for that is because they continue to lose thousands of consumer wireless customers every quarter on the face of heavier competition from T-Mobile and AT&T. I suppose what makes me a little more optimistic than most, though, is that those losses are mostly being offset right now by huge growth in business and internet. So while the consumer wireless business is struggling right now, it's at least being offset by other parts of the business, which is buying them some time here to turn that ship around. And this is clearly evident by their free cash flow actually growing in the quarter from $7.2 billion last year to $8 billion this year, which easily covers the dividend by the way. So at least for now, I would expect the dividend to stay intact, but they absolutely need to turn around their consumer business soon if they want to keep paying that dividend. Personally, I am still buying the stock myself, but only in small amounts because I realize the heavy risk of this as mostly a turnaround type of play. Next up though, General Motors reported, who saw their stock just slightly negative this week, leaving them still trading at about the same price they did a whole decade ago. So, somewhat similar to Verizon here in that sense. And it's always really traded around this $40 range with of course, some ups and downs like the huge 2020 crash during the pandemic and the subsequent skyrocket from the gas crisis that sent EV stocks soaring. But since then, it's crashed right back down to that sub $40 range, which is why I've been keeping a close eye on it lately, as I do think that it's starting to look pretty attractive here. I've never owned the stock myself, but I have often thought about picking up a few shares. When it comes to that earnings report, though, it actually looked really good in my opinion, as they not only beat on both the top and bottom line, but they also reported a huge rise in sales of over 25%, with net income skyrocketing by over 50%, and they even raised their guidance for the full year too. Much of that success is tied to their three-tiered approach of large trucks, like the strong selling ones from their GMC and Chevrolet sub-brands, Their small SUVs, where Chevy managed to capture over 25% market share in the US for the first time since 2007, and future growth with electric vehicles, which also includes their new Silverado EV that claims to have more range than both the Ford F-150 Lightning and the Rivian R1T. My guess is that Wall Street continues to beat down this stock though because of how cyclical the automotive industry is and just really how vulnerable it is to rising interest rates and an uncertain economy that could be headed for recession. A lot of people probably be not buying new cars as much during those times. But at a PE ratio of only around 5, which is more than 60% cheaper than the sector, I just think I might want to pick up some of this stock soon. I'll keep you guys posted on that, but let me know down in the comments section what you guys think about this one, because to me it's looking, pretty interesting here. Alright guys, that's going to bring us now over to Wednesday, and the big one here was definitely Meta, who I also feel had a very strong showing this quarter, not only beating on both the top and bottom line, but also reporting a very big spike in sales of over 11%, net income of over 16%, and EPS of over 21% growth. That's very impressive for their size. Keep in mind, a lot of people really think of Meta as this like declining social media company, legacy company that is, burning all their money on the metaverse. And to be fair, there is some partial truth to that. I mean, they do spend billions of dollars every single quarter on the metaverse, but I also feel that people are just really forgetting what a giant social media leader this still is, with like half the world's entire population still using their apps, which translates to over $50 billion of operating cash flow in just the past year alone. That's pretty freaking crazy. And so seeing so much growth this quarter just makes it even more impressive in my opinion. And to add on to that, they also beat on user numbers and average revenue per user, while also raising guidance for the next quarter as well, which sits at 15% revenue growth expected. Guys, that's in stark contrast to the 3 consecutive quarters of revenue declines that they were seeing up until the first quarter of this year. So they're seeing a big turnaround this year. And that likely has a lot to do with the recovering digital advertising market that I would say is based on not just Meta's earnings, but several other big names in the digital ad space that have been reporting better than expected numbers this year. Now, CEO Mark Zuckerberg also noted that looking ahead, there should be even more reason to be optimistic with launches of Llama 2, which is trying to compete with ChatGPT, Threads, which is trying to compete with Twitter, Reels, which is trying to compete with TikTok, new AI products in the pipeline, and also the launch of Quest 3, which is their virtual reality headset. As such, the stock soared by over 10% this week and is now up close to 200% just this year alone, and it's quickly recovering back up to those previous highs. I'll probably be cooling off my buying for now though, since I already bought the stock pretty heavily when it was falling, but even here it's still at a PEG of only around 1, which is more than 20% cheaper than the sector, so I wouldn't even blame anyone if they're still buying this one either. Alright guys, we're running low on time here, so I'll just try to finish these last ones really quick for Thursday, where we had notable reports from Ford, Intel, and McDonald's. Now, like GM, Ford also had a pretty strong showing, easily beating on both the top and bottom line, with sales rising by 12% and EPS by 6% year over year. However, that growth is much lower than GM's, and while Ford continues to show strong profitability on their Ford Blue segment, which is their traditional business operations, as well as Ford Pro, which is their commercial business, their Model E segment, which is their electric business, actually lost over $1 billion in the quarter and continues to have horrible margins, which is in stark contrast to something like Tesla, who really destroys these legacy players when it comes to EV profitability. For the full year, Ford also expects to lose $4.5 billion on the EV segment, which is even more than the $3 billion that they lost the year prior. And to make matters worse, management even pointed to weaker demand and slower than expected adoption for their EVs, which forced them to push back some of their production targets. In all, it was enough to send the stock falling about 5% this week, and just like GM, they continue to trade right around the same price that they did a whole decade ago. both stocks are very cheap valuation wise, but I personally like GM a little more because I just feel that they're a bit better diversified across more sub brands and styles, although I admit that may be a bit subjective. All right, moving on to Intel though, the semiconductor specialist actually soared by 8% this week and is now up close to 40% for the year in what has been a large recovery from a huge crash that still leaves them down about half their value from the top, even after this rise. Now, the reason for the climb this week was due to a return to profitability that broke 2 consecutive quarters of losses, and it really shocked analysts with a nearly 550% surprise to the upside on EPS. That's huge. However, don't let a bounce off the bottom fool you into thinking that Intel is already back to their former glory as a leader in the chips market, because revenue still fell by 15% in what is the 6th straight quarter of declining sales, which is mostly due to the weaker PC market that we talked about earlier, but also because of heavier competition from AMD and especially Nvidia, who's just killing it right now during the AI craze, as their chips are more heavily desired for AI applications. Intel stock remains a cheap one, and I do think that they will eventually turn things around, which is why I own a very small position in it myself. But after they cut their dividend down to just around a 1% yield, I decided to stop buying the stock, as I'm already up quite a bit on my position following the recent rebound, and I'm just not as excited about it as I once was. And finally, I'll just touch on McDonald's here, who is going through a bit of a weird social media craze right now, where videos are going viral of people drinking their limited edition purple milkshakes in honor of the mascot known as Grimace, and then they're pretending to, well, I'll just say fall down so I don't get demonetized, but you can look up the videos yourself. It's kind of a weird viral trend that is going on with this milkshake and these videos. But management specifically pointed to it boosting their sales, as same-store revenues climbed by almost 12% in the quarter, while also helping them beat on both the top and bottom line. They also noted that the weaker macroeconomy and specifically inflation are actually helping their sales as well, as McDonald's is generally considered a much cheaper alternative to restaurants and other fast foods. You might be surprised to see that the stock actually declined though slightly for the week. However, I actually think it makes sense given that it's already been steadily climbing for years and is trading near an all-time high with a super rich valuation that is almost 90% more expensive than the sector on a PEG ratio basis. I do like that the dividend has been grown for close to 5 decades in a row, and I also think that the business is very solid at this point, but the stock is already way too high to where I think that they would really need to have amazing results just to barely move the needle, and the dividend yield of only 2% isn't enough to make up for the limited gains that I would likely see from the stock price, so this one is a hard pass for me. Anyway, that's going to just about do it for this week's earnings roundup. Let me know what you think about all these stocks down below, and make sure you tune in next weekend because we've got even more giants reporting this next week, including Apple and Amazon. So it's going to be a ton of fun. You won't want to miss that. But thanks again for stopping by, my friends. I really appreciate all your support, and I will catch you in the next video. Take care, everybody. Bye-bye.